Okay everyone, Assalamu alaikum and welcome to the mock debrief session. I hope you people would have received the mock and would have attempted it. And there are in total 3 sections in the mock exam as mentioned on the paper as well. You have section A having 15 compulsory questions and they must be attempted for sure. In section B again you have 15 questions which are again compulsory and must be attempted. In section C, there are 2 questions which are again compulsory and must be attempted. So in total, there are 32 questions in F7 exam paper. So this is the exam format, type of the exam questions which you had to attempt. Let's start reading the questions individually. I hope you people would have attempted it. In the first question, the question says that which of the following should be capitalized in the initial carrying amount of an item of plant. Initial carrying amount is very important, that you have to write the value that should be initially capitalized, not subsequently capitalized. So if there is any point relating to subsequent capitalization, you are not going to mark that, even if it is correct. So it is very important to write the amount that should be capitalized initially. Now there are 4 options. Cost of transporting the plant to the factory. If you remember the capitalization rule of initial recognition, we used to say that we are going to capitalize the cost which is necessary to bring the asset into usable condition. And this cost actually includes the purchase price after the trade discount, any directly attributable cost, which includes transportation cost, installation cost, and this includes the dismantling cost. So these are the 3 elements that should be capitalized in the cost of the asset. So in the first bullet, question says cost of transporting the plant to the factory. So transportation cost, is it possible to bring the asset into usable condition without transporting? Obviously not. So this cost is going to be capitalized. So option C and D cannot be the right answers because the statement 1 is correct. So this would obviously also mean that option 4 is also incorrect, because in option A and B, the 4 is not there. So I just have to see whether 2 is correct or 3 is correct. Now the part 2 says cost of installing a new power supply, required to operate the plant. So this is a new power supply. So if we haven't installed a power supply, can the asset be in the usable condition? Obviously not. So this is also going to be capitalized. In part 3, the question says cost of a 3-year plant maintenance agreement. So 3-year plant maintenance agreement is obviously an asset, but this is a separate asset. This is not a part of the cost of the asset. So we are not going to capitalize this. So option 3 is incorrect. And in part 4, the question says cost of a 3-week training course for staff to operate the plant. So we also do not capitalize the training cost. So option 3 and 4 are incorrect. So the answer is actually A. This is the right answer. 1 and 3. Okay. So Muhammad Hamad is saying that he did not receive the mock exam. So Hamad, you can download it right now. Now let's move on to the question number 2, as we have a 2-hour session. So obviously we will try not to go into too much detail of the topic and to focus more on the exam, the mock exam that you were to be attempted. In question 2, the question says that when a parent is evaluating the assets of a potential subsidiary, certain intangible assets can be recognized separately from goodwill, even though they have not been recognized in subsidiary's own statement of financial position. So when we are performing the consolidation, we capitalize some of the intangible assets of the subsidiary, which are not capitalized by subsidiary. Why is that so? What do you people think? Why is that so, that we are capitalizing certain intangible assets which have not been capitalized by the subsidiary? So why do we do that? Can anyone tell me? Why do we do that? Okay. Okay, Simran is saying, what's your question, sir? Okay, our Simran wants me to repeat the question. The question is that when the parent acquires subsidiary, there are certain intangible assets in the books of subsidiary which are not capitalized by subsidiary. But in the books of parent, we still capitalize them and record as an intangible asset in the group financial statements. So the question is, why do we do that? Recognizing an asset which has not been recognized by subsidiary. Why is that so? Why do we recognize an asset which has not been recognized by subsidiary? Simran is saying because external valuation is required before recognition. Ahmed is saying because parent cannot estimate the cost. Okay, Ahmed is saying while we can. Basically, the point is that for subsidiary, these intangible assets are an internally developed intangible assets. And as they are internally developed intangible assets, they are not capitalized because their cost cannot be measured reliably. But when parent acquires it, parent has actually paid a cost. Parent has actually paid a cost to acquire them. Therefore, the parent would recognize them and capitalize them as an asset separately. Because for parent, that is not an internally developed, for parent, that is a purchased intangible asset. So that is why we capitalize it as an intangible asset. So it is necessary to meet the criteria of IAS 38 even in case of parent. What are the criteria for purchase asset? The cost can be measured reliably and the probable economic benefit should be there. Okay, Smita wants me to explain again. Actually, Smita, the point is that if I write it down, that the intangible assets are internally generated by subsidiary and therefore are expensed out. But for parent has paid a cost against them to acquire them. Therefore, for parent, it is not an internally generated asset, instead is a purchased asset. Therefore, parent should capitalize the asset. So this is why we are actually capitalizing the asset, because for parent this is a purchased intangible asset and not an internally generated intangible asset. Getting the point, Smita? Now let's see. The question says that which of the following is an example of intangible asset of the subsidiary which may be recognized separately from goodwill when preparing the consolidated financial statement. So which one is the example in this case? Okay, so the example is in A. The question says that a new research project which the subsidiary has correctly expensed to profit and loss, but the directors of the parent have reliably assessed to have a substantial fair value. So this is a new research project which subsidiary has correctly expensed out to profit and loss, but the directors assume that it has a substantial fair value. So this should this be capitalized? The answer is yes, because for parent the research project is a purchased research project, and if you remember in IAS 38 we have discussed that the purchase research is always capitalized. So this should be capitalized in the books of parent. Hamza Ahmed is saying the part answer is A. Okay, Simran, I will show you the first question. In part B, just give me a second. Okay, now Simran has a question, sir, but the probable economic benefit cannot be measured in research. Simran, if you remember the topic of IS 38, when we have studied over there, we had discussed that all purchased intangible assets are capitalized. Even if it is a purchase research, we still capitalize it because there is a probable economic benefit which cannot be measured reliably, but obviously there is an economic benefit. That's why we are paying for that. So even in this case, if you see, the question has said that it has a substantial fair value. So if it is having a substantial fair value, it means that the economic benefit is obviously there. So if there is any research having no fair value, we would say that there is no economic benefit in acquiring it. But the assets which have a fair value means they have the fair value because there is some economic benefit from that. In part B, the question says that a global advertising campaign which was concluded in the previous financial year and from which benefits are expected to flow in the future. So do we capitalize advertising campaigns as an intangible asset? The answer is no. So the option B is actually incorrect because the marketing campaigns, the advertising campaigns are not capitalized as an intangible asset. In part C, the question says that a contingent asset of the subsidiary from which the parent believes a flow of future economic benefit is possible. So if there is a contingent asset in the books of subsidiary, yes, we do capitalize it, but not as an intangible asset. We capitalize it as a contingent asset. So this is also not the answer. And finally, a customer list which the directors are unable to value reliably. So yes, customer lists do capitalize if they are purchased, but as their value are not reliably measurable, we are not going to capitalize this. So your answer to part 2 is actually A. This is the answer to the question. This is the answer to the question in this case. Simran, here you go for part A. I think we have marked the incorrect value. The answer is B, 1 and 2. That we have discussed above as well, that 1 is correct, 2 is correct, 3 is incorrect, 4 is incorrect. So the answer is 1 and 2. So for 1, the answer was B. For 2, the answer is A. Yes, Simran, I've just said that contingent assets are capitalized if they are of the subsidiary. Contingent assets are capitalized if they belong to the subsidiary. But in this case, they are not being capitalized as intangible asset. They are being capitalized as a contingent asset. So that is why the option was not correct. Okay, now question number 3. The question says that on 1st October 20x4, Flash Company acquired an item of plant under a 5-year lease agreement. So we have acquired a plant under a lease agreement. At that date, the present value of the total lease payments was $25 million. The agreement had an implicit finance cost of 10% per annum and required immediate deposit of $2 million with an annual rental of $6 million paid on 30th September each year for 5 years. So the question is given as the present value of total lease payment is 25. So what entry we are going to prepare is the asset debit, an asset by the name of right to use by $25 million, because this is the present value of all payments, out of which the payment that we have already made is of $2 million and the lease liability would become of $23 million. So why are we not calculating the present value of this all future cash flows? Yes, Simran, they are capitalized in the group if they belong to the value at the date of acquisition. So why are we not calculating the present value of all future cash flows? Because the question has already given us the present value of all cash flows. So out of those present value, we have paid $2 million. So the remaining cash flows are $23 million. Now the question says that what is the current liability of the lease in Flash Company's statement of financial position as at 30th September 20x5. So we need to calculate the current liability. So for that we used to prepare a table. Here, brought down, interest expense, rentals, after rentals we have repayment, and then the carried down. So in the first year, the lease liability was 23, interest expense is 10%, which would become 2.3, the rentals was 6, so the repayment is 3.7, and the carried down is 19.7. Brought down is 23, interest expense is 2.3, rentals are 6, repayment is 6 minus 2.3. Repayment is 6 minus 2.3, which is going to be 3.7, and the carried down is 19.7. So the year end was 30th September 20x5, and we have taken the asset on lease on the first day of the year. So this is the total liability at the year end. At the year end, this is the total liability, but we have to distribute it into current and non-current. So we are going to prepare one more year, which is going to be 19.7 as brought down. 1.97 is the interest expense, 6 is the repayment, is the rentals, and 4.03 is going to be the repayment, if I'm right. Let me use a calculator for this. Okay, so 6 minus 2.3 was 3.7, minus 23 is 19.3. Okay, this is not 19.7. This is 19.3, which is the total liability. So the brought down is going to be 19.3, and interest expense is going to be 1.93. So the repayment is going to be 6 minus 1.93, which is 4.07, and after 4.07 the carried down is going to be 19.3 minus 4.07, which is 15.23. So this 15.23 is the non-current liability and 4.07 is the current liability. So the question was asking what is the current liability of the lease. So your answer is B. 4070000 is the current liability for this question. Thank you, Harsh. Shazeb is saying that in the entry why not bank is 8, why 2? Actually, Shazeb, we have prepared the entry as of the year 0. If you're preparing the entry for the entire year 1, then you would be using 8, 2 as the initial amount and 6 as the rentals being paid at the year end. So this is the entry that we have prepared for the initial entry, not for the year end. So this was the first page of the mock exam. Now let's move on to the next. The time that we are taking per question is too much high because it's already 20 minutes in 3 questions. So we are approximately taking 6 minutes in each question, which is too much high. So let's move on to question number 4. The question says that the financial statements represent transaction in words and numbers. To be useful, financial information must be represented faithfully, or must represent faithfully these transactions in terms of how they are reported. So this question actually relates to the topic of framework, where faithful representation means what? Faithful representation means accounting for the transactions according to the prudence concept and the substance over form concept. That look at the substance form and not at the legal form. So the question, the correct answer will either relate to the prudence concept or would relate to the substance over form concept. Okay, Smitha is giving an idea to discuss section C first and then B and then A. Smitha, actually why I'm discussing section A is because this is the most difficult area for the students in the exam. So I would want more time to give to section A. Section C, we have already discussed a lot of questions, and the question by the name of Candy was pretty similar to the question of triads that we have already discussed. So So as we have already discussed section C questions in a lot of detail, we have done 7 questions approximately. That would make a lot of marks, but for the MCQs we have comparatively covered less. That's why I'm focusing more on the MCQs and less on the section C. Okay, now the question says that which of the following accounting treatments would be an example of faithful representation. So in A, the question says charging the rental payments for an item of plant to profit or loss when the rental agreement meets the criteria for a right to use asset. So the question is saying that we should charge the rental payment as an expense to P&L. Is this correct? Obviously not. Even the accounting is incorrect. So this is against faithful representation. This is against faithful representation, not the faithful representation. And then the question says including a convertible loan note in equity on the basis that holders are likely to choose equity option on the conversion. This is also incorrect because convertible loan notes are not classified in equity. They are classified as a compound financial instrument, and we classify both of them as both liability and equity. So this accounting is also incorrect. Treating redeemable preference shares as a part of equity in the statement of financial position. This is also incorrect because redeemable preference shares are a non-current liability. So option 1, 2, 3 are incorrect. Yes, Simran. And in part D, we say de-recognize factored trade receivables. The word factored means sold. So we should de-recognize the receivables that we have sold without recourse to the seller. Without recourse to the seller means transferring the risk to the seller. Transferring the bad debt risk to the seller. So if we have sold the receivables with a transfer to the factor, I would say. So if we have sold the receivables along with the bad debt risk, then we should de-recognize the receivables. Now that is the correct answer. So your answer to question number 4 is actually D. Your answer to question number 4 is actually D. Hamza, part A is wrong because the question says that charge the rental payments to P&L, where the rental agreement meets the criteria for a right to use asset. So when the criteria of right to use are met, we should recognize the asset, we should capitalize the asset, and the rental payments will reduce the lease liability and will not be recognized as an expense. Yes, Simran. Okay, Sheikh Saqib Hassan is asking that what is recourse. Sheikh Saqib, I've just discussed that if we say recourse, this means the bad debt risk is not transferred to the factor. And when we say without recourse or non-recourse, we say that the bad debt risk has been transferred. So there are two types of statements: recourse factoring and non-recourse or without recourse factoring. Non-recourse or without recourse factoring. So recourse factoring means that the bad debt risk is not transferred. The bad debt risk is not transferred. And non-recourse means that the bad debt risk has been transferred. Okay, Shazeb Mohammed is saying why not B? Shazeb, because in B the question is saying including convertible loan notes in equity. Are the convertible loan notes recorded in equity? No, they are split between liability and equity. So the accounting mentioned in part B is incorrect. We did not record convertible loan notes as equity. Based on that the shareholders or the loan note holders would select the conversion option. So even if they are going to select the conversion option, still we record it as both liability and equity and not only as an equity. Thank you, Saqib. Okay, now let's discuss question number 5 now. In question number 5, the question says that on 1st October 20x4, Caletra company commenced drilling for oil from an undersea oil field. Caletra company is required to dismantle the drilling equipment at the end of its 5-year license. this has an estimated cost of $30 million on 30th September 20 x9. So this $30 million is actually a future value. This $30 million is actually a future value. Now the question is saying that what is the provision which Kelletra company would report in its statement of financial position at 30th September 20 x5, which is 1 year after the date of installation of the plant, in respect of oil operations. So the question is asking us to calculate the amount of the provision. What amount of the provision will be recorded? So we are going to calculate the amount of provision. So the initial value, the initial estimate of the provision is going to be $30 million divided by Kelletra company's cost of capital is 8%. So the question is already given as the value that $1 in 5 years time has a present value of 0.68. So 30 million into 0.68 is going to be the value. 30 million into 0.68 is going to be the value. So 30 into 0.68 is going to be, can you give me the value? 20.4. And then we are going to unwind the liability by 20.4 into the 8% rate. So what we are getting the value? 20.4 into 8%. Can you tell me the value? 20.4 into 8% is 1632 or 1.632 million. So the total is going to be 22.032 million. So your answer is actually B in this case, because the present value at the year end is going to be $22.032 million. Thank you everyone for telling the answer. So I hope this was an easy question. Now let's discuss adjustment number 6. Adjustment number 6 is about IAS 21. So let me discuss a basic point of IAS 21. Then in IAS 21 we talk about foreign currencies, foreign transactions which occur in the foreign currency. Now the foreign transaction may be a P&L transaction or maybe a balance sheet transaction. All P&L transactions are initially recorded at the rate on the date of transaction. They are recorded at the rate on the date of the transaction, which is exactly similar to the balance sheet items as well. All transactions are initially recorded at the rate, that is the spot rate, the rate at the date of the transaction. And then at the year end, P&L items are brought to the average rate. They are being brought to the average rate for the year, and balance sheet items are recorded according to the closing rate. As we have not discussed IAS 21 in detail in the session, so that is why I'm covering a bit of it, that all foreign transactions are initially recorded at the rate on the transaction date. And then subsequently at the year end, all P&L items are retranslated and brought to the average rate, and all balance sheet items are normally retranslated to the closing rate. So if I read the question says when a single entity makes purchases or sales, which are actually P&L items, in a foreign currency, it will be necessary to translate the transactions into its functional currency before the transactions can be included in the financial records. So we are going to convert the currency into the local currency. In accordance with IAS 21, the effects of changes in foreign exchange rates, which of the following foreign currency exchange rates may be used to translate the foreign currency purchases and sales? So initially we are going to use the transaction date rate and subsequently the average rate. So we have 4 options. Option 1 says the rate which existed on the day, that the purchase and sales took place. So yes, this is a relevant rate. We are going to translate this. Yes, Simran, you are right. In point number 2, the question says the rate which existed at the beginning of the accounting period. No, this is not relevant. The average rate for the year provided there has been no significant fluctuation throughout the year. So now the question is talking about the average rate. So is average rate relevant? Yes, it is relevant because this is a P&L item. And the rate which existed at the end of the accounting period. So this is not relevant. End of the accounting period relates to balance sheet mainly. So your answer is 1 and 3. So the answer would become D. So the correct answer to question number 6 is actually D. Thank you, Kuli. Similarly, if we move on to the question number 7, I'm going a bit fast because we have less time in today's session. We have only 2 hours, and out of that, 30 minutes have been passed by. So we even have to do the part B and the part C, section B and section C. So in question number 7, the question says that on 1st October 20x4, that is exactly start of the year, Hoy company had 2.5 million equity share capital with 50 cents each. So I would say the opening shares were actually 2.5 million divided by 50 cents. So this would give us the number of shares as being 5 million. No new shares were issued during the year ended 30th September 20x5. So these are also the closing shares because no shares have been issued during the year. But on that there were some outstanding share options, but we have some share options over here which had a dilutive effect equivalent to issuing 1.2 million shares for no consideration. So the share options are of 1.2 million for no consideration. So these are the weighted average number of these are the potential shares for the share option. Hoy's profit after tax for the year ended 30th September 20x5 was 1550000. Yes, Hamza, you are right. In accordance with IAS 33 earnings per share, what is Hoy's diluted earnings per share for the year ended 30th September 20x5? So now we need to calculate the diluted earnings per share. So first we are going to calculate the EPS. In fact, as the question has already mentioned that this has a diluted effect, so it's not necessary to calculate EPS, but let's do it still, being on the safe side. So the profit is 1.55 million and the weighted average number of shares is 5 million. So you are going to get the EPS for this. And then for diluted earnings per share, we are going to divide 1.55 by 5 million plus 1.2 million to get the diluted earnings per share. So can someone calculate quickly? 1.55 divided by 5? 3.1 or 0.31? Okay, 0.31 is the EPS, and then let's calculate the diluted EPS. 1.55 divided by 6.2. It's 0.25. Okay. So for example, if the diluted EPS was above 0.31, for example, if the diluted EPS was above 0.31, we would have marked part C. If the diluted EPS was above 0.31, let's say 0.35, 45, 55, 65, any value above 0.31, then the answer would have become C. But in this case, the answer is A. So the diluted earnings per share is actually 0.25. Because diluted earnings per share means the worst possible EPS. So this can never be above EPS. So even if it is above EPS, we would say the diluted EPS is the same as EPS. Okay, that's good. Ahmed, you've got the point. Now let's discuss the next page, question number 8. The question says that Fork Company owns 80% investment in Spoon Company, which it purchased several years ago. So we have an 80% share. The goodwill on acquisition was valued at 1,674,000, and there has been no impairment of the goodwill since the date of acquisition. So this is the amount of goodwill. Now what does the question want? What is the profit or loss on disposal before tax, which will be recorded in Fork Company's consolidated statement of profit or loss for the year ended 30th September 2024. So the question is talking about disposal. Okay, Simran, I will take you to this to the screenshot after this question. So now the question is talking about disposal of a subsidiary. What entry do we make in case of disposal? We record the bank as debit. We de-recognize the subsidiary as NCI debit, net assets credit, goodwill credit, and the balancing figure is the gain or loss on disposal. So if I have disposed of a subsidiary, I have received cash, bank debit. I have to de-recognize the subsidiary by de-recognizing the NCI, de-recognizing the net assets, de-recognizing the goodwill, and the balancing figure would become the gain or loss on disposal. Simran, we have a limitation today of time. So if we go in too much of slow space, that would result in unable to complete the mock exam. So this is the entry for the disposal. So you have to learn this entry. Now the question says that the goodwill was 1,674,000. So I would say when we have disposed of the subsidiary, it is going to be goodwill credit by 1.674. Simran, I have already written the debit and credit, bank debit, NCI debit, net assets credit, goodwill credit, and the P&L being the balancing figure, which can be on both debit or the credit side. So when we have disposed of a subsidiary, the bank is going to be debit, NCI debit, net assets credit, goodwill credit, balancing figure P&L. You have to learn this entry by your heart. Now the question says that on 30th September 2024, Fork Company disposed of its entire investment in Spoon Company, the details of which are as follows. Sale proceeds of Fork Company's entire investment is 5580. So this is the amount of bank that we have received. 5.58 million. I'm writing all of the entries in millions. Cost of Fork Company's entire investment, which is not relevant to us because this is something not relevant to the group. Immediately before the disposal, the consolidated financial statements of Fork Company included the following amounts in respect of Spoon Company. The carrying amount of the net assets excluding goodwill was 4,464. So this is relevant. Net assets 4.464. The carrying amount of the NCI was 900. So the question is given 900 as the NCI. So 0.9 is the NCI. Now you have to calculate the balancing figure 5.58 plus 0.9. 5.58 plus 0.9 minus 4.464. So I'm using the calculator. 5.58 plus 0.9 minus 4.464 minus 1.674. So this is going to give us a profit of 0.342 as this is a positive value. So positive value would mean a gain and a negative value would mean a loss. The positive value would mean a gain and the negative value would mean a loss. So the answer is C. 342,000 as the profit. Yes, Simran, if there was a loss, we would have debited it. Okay, so you people can take the snapshot quickly. Query to remove NCI. We are debiting NCI to remove NCI because it is of a credit nature. So to remove NCI, we debit it. To remove goodwill, we credit it because it is an asset. And to remove net assets, we credit it. So anything which is an asset will be credited to be removed, and anything which is a liability will be debited to remove. Okay, so now you people wanted a snapshot of this screen. You can take the snapshot. Shazib wants the snapshot of question number 6. Shazib, here you go for the question number 6. Thank you, Elvis. Elvis is saying this is a very simple way to calculate the gain or loss. And this is pretty simple because of the double entry. The accounting means double entry. So, whenever you people get confused with the accounting of anything, follow the concept of the double entry, that what should be debited and what should be credited. Now let's move on to the question number 9, where the question says that the consolidated financial statements are presented on the basis that the companies within the group are treated as if they are a single economic entity. So yes, when we are preparing a group financial statements, we treat them as a single entity, and we prepare the financials of the entire group treating it as a single entity. Which of the following are requirements of preparing consolidated financial statements? So which of the following are the requirements of preparing a consolidated financial statements? So let's see. The question says that all subsidiaries must adopt accounting policies of the parent in their individual financial statements. So are the subsidiaries required to follow the accounting policies of the parent even in their individual financials? The answer is no. They have to follow the policy of the group in the group accounts, not in the individual financials. They have to follow the accounting of the group in their individual financials and not in the group. They have to follow the policy of the group in the group financials and not in the individual financials. Subsidiaries with activities which are substantially different to the activities of other members of the group should not be consolidated. There is nothing such rule. All subsidiaries should be consolidated irrespective of the activities. All subsidiaries are consolidated irrespective of their activities. So 1 and 2 are incorrect. So if I see A is not going to be correct because it has 1, 2 is not going to be correct because it has 2, and D is not going to be correct because it has both 1 and 2. So the answer is obviously C. So even in the exam, if you are not getting all of the 4 points, that 1, 2, 3, 4, you are not getting all of the 4. So you have to do the smart work to see that you know that 1 is incorrect. So option A and D are gone. If 1 is incorrect, which means option A and D are gone. This is not the right, this is not the right. So this means 4 is always the right. So you are not required to read the 4. Just read 2 and 3 and decide which one of them is correct and which of them is not correct. So let's read further. All entity financial statements within a group should normally be presented on the same accounting year prior to consolidation. Yes. If parent's year end is different and subsidiaries year end is different, if parent year end is different and subsidiaries year end is different, in that case, subsidiary would be required to prepare financials as per the parent's year end. Subsidiary would be required to prepare the financials as per the parent's year end. So this statement is actually correct. And in 4, the unrealized profits within the group must be eliminated from the consolidated financial statements. So yes, we do remove the unrealized profits. So the answer is actually C for in this case. Yes, Simran, you are right. Smita wants me to repeat these statements. Smita, I have said that all subsidiaries are consolidated. All subsidiaries are consolidated. If you people want, I can write the rules over here so that you people can take the snapshot. All subsidiaries are consolidated irrespective of the type of their activities. So for example, the parent is in the service industry and the subsidiary is in the manufacturing industry, so we are going to still capitalize them. The nature of the activities are not relevant to us. So all subsidiaries are consolidated irrespective of the nature or the type of their activities. Is it clear, Smita? Okay, so moving back onto the previous slide, we are done till the question number 9. Now let's read question number 10. That's good. Now in question number 10, the question says that a parent company sells goods to its 80% owned subsidiary during the financial year. So some of which remains in the inventory at the year end. So parent has sold goods to its subsidiary. So this means that the profits of parent would have been overstated and the inventory of subsidiary would have been overstated. So what is the adjustment required in the consolidated statement of financial position to eliminate any unrealized profits in the inventory? So what is the entry required? Can you people tell? Retained earnings debit because we have to remove the profits, and inventory credit because we have to remove the profit. So this is the entry at the amount of the unrealized profit. So option A gives an option debit group retained earnings and credit inventory. So this is the right answer. B is not correct because in B we are distributing the profit between parent and NCI. Option B would have been correct. Option B would have been correct if the transaction would have been from subsidiary to parent. If the transaction would have been from subsidiary to parent, in that case we would have debited both the retained earning and the NCI. So if you want me to write the entries over here, I would say when the transaction is from parent to subsidiary, unrealized profit from parent to subsidiary, in this case we prepare the entry as debit retained earnings and credit inventory. And in case of unrealized profit from subsidiary to parent, we debit retained earnings, we debit the NCI, and then we credit the inventory. So you have to remember these entries of how do we remove the unrealized profit from subsidiary to parent and from parent to subsidiary. Actually, Simran, this means that, for example, if subsidiary would have sold goods to parent, having the carrying amount of 10 being sold for 15, so subsidiary would have recognized a profit of 5 and parent's inventory would have been overstated by 5. So when we prepare the entry as retained earning 5 and the inventory 5, so the decrease in retained earnings, will it affect the parent only or will it affect the NCI as well? What do you think, Simran? If I'm reducing the retained earnings of the subsidiary, will only parent be affected or NCI will also be affected? NCI also. So that is why instead of saying retained earnings debit, we say that we are going to debit both the retained earnings and the NCI. So if the parent's holding percentage is 80%, we are going to record 4 million in retained earnings and 1 million in the NCI. So this is the entry when the subsidiary sells goods to parent. But if the parent has sold goods to subsidiary, in that case the entry would become retained earnings debit and the inventory credit simply by 5 million, because we are reducing the parent's retained earnings and subsidiary's inventory. So parent's retained earning will only affect the retained earning of the parent and not the NCI. Yes, Simran, now you have got the point. So if you people want to take the snapshot, I'm going to delete this area because I want this sheet to be related to the rules only. Taking the snapshot. Okay. So now let's move further. We are done up to question number 10. Now we are moving towards 11. I hope that you people are not finding the mock too much difficult, because sometimes if the mock is too difficult, that breaks down the confidence of the students. I hope that the mock is building the confidence rather than reducing it. Simran, your questions are right now telling me that you don't have the exact concept. So if I go into too much detail of your questions, that would become more time consuming. Okay, Harsh is saying that section C is very difficult. Okay, so far section A, do you find it difficult? Up to 10 questions. Even if you have done 5 correct out of 10, you are passing the exam. So you just have to correct it to mark 50% of the questions correct, obviously. So let's see question number 11. The question says that I'm starting from the requirement that on the assumption that Ambil company is an associate of Candy company, what would be the carrying amount of the investment in Ambil company in the consolidated statement of financial position of Candy company as at 30th September 20x5? So we need to write down the carrying amount of the associate. We need to calculate the carrying amount of the associate. So let's read the question. Candy acquired 240,000 of Ambil's 800,000 equity shares for $6 per share. So we have acquired 240,000 for $6. So what will be the value? 240,000 into 6, 1,440,000. So I can say 1.44 million. And we have a holding of 240 out of 800. So if I calculate the percentage, I would say 240,000 divided by 800,000 into 100, that would become 30%. So we have a 30% holding and we have invested 1.44 million initially, which is on 1st October 20x4. Now the question says that Ambil company's profit after tax for the year ended 30th September 20x5 was 400,000. So obviously we also have a share in this, and the entry is investment debit, retained earning credit. So out of this 400,000, our share is going to be 30%, which is going to be 120,000. So the investment is going to be increased by 0.12 million. Investment debit, retained earning credit by 1.12 million. And then it has paid an equity dividend on 20th September 20x5 of 150,000. So the entry is going to be bank debit and investment credit by 150,000 into 30%, which is going to be 45,000. So our investment is going to be reduced by 0.45. Okay, so the answer is 1515000. 1.44 million plus 0.12 million minus 0.45 million. Ahmed Judai is saying, is this mock made by you and what is the difficulty level? Actually, Junaid, do anyone know from where I have taken the mock? Do anyone know from where I have taken the mock? It's not made by me. It's not made by me. Kuli knows that from where it is. Yumna also knows. Harsh says past papers. Neeraj is saying kit. This is actually the specimen paper of F7 since the last change. So this is actually the specimen paper, not from Kaplan, not from BPP, not from the past papers. This is a specimen exam. Yes, Neeraj, actually, Neeraj is saying that I've done so much similar questions in the kit because the kit has made the questions from the specimen exam. That is why, Neeraj. The kit has to follow the past papers and the specimen exam. So that is why the number of the type of questions are going to be the same in each case. So now let's complete the questions section A. So we have already invested approximately an hour in this. The question says that quartile company is in the jewelry retail business, which can be assumed to be highly seasonal. For the year ended 30th September 20x5, quartile company assessed its operating performance by comparing selected accounting ratios with those of its business sector average as provided by an agency. Assume that the business sector used by the agency is a meaningful representation of quartile's company's business. Which of the following circumstances may invalidate the comparison of quartile companies' ratios with those of the sector average? So which of the following? Yes, Elvis is saying this means that this is how the exams will look. Exactly, Elvis. I've taken the specimen exams so that it meets the difficulty level of the exam. It is according to the examiner's approach. It is according to what ACCA expects from the students. So that is why I've taken the pilot paper for you people. Okay, so now under which circumstances the comparison is going to be invalidated? Now the question says that in the current year, quartile company has experienced significant rising cost from its purchases. So if we have been experienced significant rise in the costs, is the comparison invalidated? What do you people say? Is this correct or not? Harsh is saying no. Everyone is saying except for Neeraj. Okay, actually the answer is no. This will not invalidate the ratio analysis. So this statement is incorrect. This will not invalidate the comparison. In fact, this is more important for the comparison, because if someone cost is rising, obviously its ratios would decrease, and this should be known by the investor. So this is an important aspect from the ratio analysis. The part 2 says, okay, I also have to teach you some I would say smart work. So if I know a statement 1 is incorrect, so option A is incorrect and D is incorrect. Option A is incorrect and D is incorrect, which means that 2 will always be correct. So I do not have to think over 2. I have to think whether 3 is correct or 4 is correct. So, but still, let's see what is point number 2. The sector average figures are compiled from companies whose year ends are between 1st July 20x5 and 30th September 20x5. So the averages have been taken from the companies having different year ends, and the business is highly seasonal. So if the business is highly seasonal, would the year ends invalidate the comparison? Yes, because if my year end is July, your end year is August, someone's year end is September, how would we compare with each other? No, Simran, 3 months is not like to like. So option 2 is correct, that this would invalidate. Now the third bullet says that quartile does not revalue its properties but is aware that other entities in the sector do. So if I am not revaluing and others do, will this invalidate? Yes, this will invalidate, because if I'm not revaluing, my equity will be less and my ROCE and ROE will be higher. Plus, if I'm not revaluing, I'm charging a lower depreciation as compared to others. Therefore, my ratios would not be directly comparable. So 3 is correct, which means the answer is C. And indeed, the question says that during the year, quartile company discovered an error relating to the inventory count at 30th September 20x4. This error was correctly accounted for in the financial statements for the current year. So if this has been already accounted for, then will this invalidate the comparison? No. If the error would not have been corrected up to now, then it would invalidate the ratio analysis. But if the error has already been corrected, then there is no problem in that. If the error would not have been corrected up to date, in that case we would have said that this is going to invalidate the analysis. Simran is saying, why is this prospective? Simran, who said this is that this is prospective? Have we said that this is prospective? The question has said that we have correctly accounted for, which means that the question has applied the correct accounting, and the correct accounting is retrospective application for the correction of an error. Okay, so now let's discuss question number 13 and then 14 and then 15. And we have passed 1 hour. So the question says that which of the following criticisms does not apply to historical cost financial statements during a period of rising prices? Which of the following criticisms does not apply? Does not apply. This is important that we have to select which does not apply. So let's see. So what are the criticisms of historical cost? They are difficult to verify because transactions could have happened many years ago. So is this a right criticism? That it is difficult to verify the transactions because they would have happened many years ago? Is this a criticism of historical cost? That we cannot verify if that because the transaction would have been incurred a long time ago? Okay, a lot of yes, but the answer is no. This is not a criticism. This is not a criticism. Because why should we verify a transaction which has happened many years ago? We would have verified at that time. There is no requirement of verifying the transaction now. If a transaction has been done 50 years ago, the auditor would have verified it 50 years ago. Why should I verify it right now? So this is not a criticism, which means that this is an answer. This is not a criticism because we are not required to verify any values of the previous years. They would have been verified by the auditor at that time. So this is not a criticism. Part B says that they contain mixed values. Some items are current values and some are not. So this is a criticism. This is a criticism that if I'm following the historical cost and an asset has been purchased 50 years ago, so that asset is at a value of 50 years ago, and the asset that I'm purchasing right now relates to the current value. So few assets will be of old values and few assets will be at the current value. So this is a criticism of historical cost. They understate assets and overstate profits. So if I'm following the historical cost, the time value of money would have been lower at that point of time. So that would understate my assets. Yes, this is the right criticism. And if the assets are understated, the depreciation will also get understated, and the profits will be overstated. So yes, this is a right criticism. There's no harm in this. And the D says that they overstate gearing in the statement of financial position. So yes, this is also right. Because if I revalue the assets upwards, this would increase equity and reduce gearing. If I revalue, this will reduce gearing, and if I'm not revaluing, this would increase the gearing. So yes, this is the right criticism. So other than A, all of the remaining are the criticisms of historical cost. Emma Junaid is saying, from where should we solve? From which year should we solve the past papers? Emma Junaid, I would suggest that you should solve the past papers after the specimen exam. So you can solve specimen exam, you can solve June 16, September 16, December, let me recalculate. You have to solve after the specimen exam. So after specimen exam, you have the recent past paper of March, June 17, you have December 16, you have September 16, and you have June 16. So these are the 4 attempts that you can solve as a full scale. So June 16, September 16, December 16, and you have March, June 17. So you can solve all these, and the specimen you have already solved in the mock. Now the question further says that the following information has been taken or calculated from Fowler's financial statement for the year ended 30th September 20x5, where the cash cycle at 30th September 20x5 is 70 days. Now how do we calculate the cash cycle? How do we calculate this cash cycle? This is inventory days plus receivable days minus the payable days. This is how we calculate the cash operating cycle. And the cycle is of 70 days. Similar, minimum 2 to 3 past papers should be done. Minimum 2 to 3 past papers should be done. Now the inventory turnover is 6 times. How do we convert the times into days? How do we convert the time into days? How do we convert the time into days? Let me write in the rules. If you want to convert time into days or days into times, what you can do is that you can apply the formula 365 divided by 365 divided by the times or the days. So if you apply the formula as 365 divided by days, you are going to get the times, the answer in times. And if you divide 365 divided by the times, you are going to get the days. So simply 365 divided by the answer. Yes, Shazib is right. So let's move back. The question is given us 6 times. So I'm going to convert this into days by 365 divided by 6, which is going to be 60.83333. So we can say 61 days plus receivable days is the value that we are going to calculate minus the payable days. So the question has given us the year-end payables to 30,000 and the purchases as 2 million and the cost of sales as 1.8. So cost of sales are irrelevant. So I'm going to use payables as 230,000 divided by credit purchases of 2 million into 365. So I'm getting approximately 42 days. So 70 is equals to 61 plus x minus 42. So x is equals to, now this is something which is called maths, 70 minus 61 and plus 42, which is going to be 51 days. So your answer to question number 14 is D. Simran, you can take the snapshot later on for the rules. Okay, here you go. Okay, good. So now we are done with the question number 14 as well. If you people have any confusion, you can ask. Now we are going to solve the last question for section A. The question says that on 1st October 20x4, Pyramid Company acquired 80% of Square Company's 9 million equity shares. So we have acquired 80% of 9 million equity shares. At the date of acquisition, Square Company had an item of plant which had a fair value of 3 million in excess of its carrying amount. So if I prepare the working one, which is net assets at the date of acquisition and at the date of balance sheet, I would say that the ordinary share capital is of 9 million, which means 9,000. and there would obviously be retained earnings, and there's a fair value adjustment relating to plant by $3,000. And the question says that at the date of acquisition, it had a useful life of 5 years. So it has a life of 5 years on this date, and the year is September 20x5, which means that a year has been passed. So the depreciation is going to be 3 million divided by 5 years, which is 600. So the net book value would become 2,400 at the balance sheet date. Now, pyramid company's policy is to value the non-controlling interest at fair value at the date of acquisition. So the question wants to value the NCI, which we calculate in working number 3 at fair value. For this purpose, Square companies had a value of 3.5 each at that date. So fair value would become 3.5 into NCI shares, which is 9 million into 20%, 1,800. 9 million into 20% would become 1,800. 9 million into 20% is 1,800 shares of NCI into each share is of 3.5. So the total would become 6,300 for the fair value of NCI at the date of acquisition. Thank you, Kuli. In the year ended 30th September 20x5, Square Company reported a profit of 8 million. They have reported a profit of 8 million. So this means I would say that the profit was 8 million, assuming 0 at the date of acquisition. So this would become 12,000, and this would become 9 plus 8 plus 12, 2,400. So this is 19,400, which means the profit has been increased by 7,400. So out of 7,400, NCI has a 20% share, which is going to be 1,480. Now the question's requirement was at what amount should the non-controlling interest in Square be valued in the consolidated statement of financial position. So the question wants us to value the NCI, which is 6,300 plus 1,480. So this is going to be 7,780. Nazia, we have charged the depreciation. We have written 2,400 over here. So after charging the depreciation, so you can even do like this, that you write 3,000, 3,000 on both the places and then charge 600 depreciation. This is what you do, Nazia. So it is the same of writing 3,000 and negative 600 separately or 2,400 on a net basis. So your answer to question number 15 was actually C. Any confusions? Smitha, can you please specify exactly where you are getting confused? Okay, now the total shares of the subsidiary were actually 9,000 and we have acquired 80%. So 20% actually belongs to NCI. So that would become 1,800 and then 3.5 is giving us 6,300. So this is how we have calculated 6,300. Total shares of NCI into 20%. Syed Maz is asking, shouldn't we be taking 80% of 9 million? Syed Maz, if you take 80% of 9 million, you are going to get the shares of the parent, not of the NCI. And over here we are trying to calculate the NCI value. Smita is saying the whole thing. Smita, that is a bit difficult of explaining the whole thing again. Actually, what we have done, we have first calculated the fair value of NCI. Are you getting this? Of how have we calculated the fair value of NCI? Okay, that's good. Smita has got herself. Yes, Syed Maz, 9 million is the total number of shares because we have acquired 80% of Square's 9 million shares. So 9 million shares is the total number of shares. Angela is saying, what about 1480 amount? Angela and someone else has also asked, Simran, that if we see the net assets have increased by 7,400, out of which 80% belongs to the parent and 20% belongs to the NCI. So 7,400 into 20% is what belongs to NCI, which is 1480. So this is how we have calculated 1480. Angela and Simran. Getting the point? Okay, welcome. So now we are done with the section A up to now. Neeraj is saying that he have got 18 marks out of 30. 9 questions done correct. So that is good, Neeraj, because you had to score 15. So you are 3 marks above your target. No Simran, no break in today's session. We are going to continue directly. Okay, now because we are short of time and we are left with only 45 minutes, I would want you people to answer that should we be going for section B or section C? Because we cannot cover both of them entirely. So would you want me to cover section B or section C? Your poll will decide what to do. Okay, a lot of quick answers. Let me see. Simran is saying section C, Neeraj section B, Harsh is saying section C, Hamza section B, Kohli section B, Ahmed section C, Shazib section B, Simran section C, Bilal section C, Namra section B, Harsh is saying single entity, Yumna is saying section C, Bilal is saying ratios. So a lot of B and a lot of C, and that is quite different for me to identify the quantum, because I think both are equally marked by the students. Okay, so what we can do is if we do it like this, that we solve section B, and then I can provide you the answer to the section C in my format, so that you people can solve this on your own, and then the problems can be discussed on the WhatsApp. Would that be better? Or because section B cannot be solved, I cannot provide you the answers of section B separately. Okay, so Shazib is saying perfect. Harsh is saying sounds good. What about others? Is that good enough? We solve section B and I provide you the answers of section C in my way, the answers of the ratios, the answer of the final accounts, and then if you people have any problem, you can discuss on the WhatsApp group. Okay, Smita is saying do section C please, and others, all of the others are agreed. Okay, Smita, I would apologize because I have to follow what majority says. So let's start section B. But don't worry, Smita, if you have any problem, you can you can discuss with me personally on the WhatsApp. I will try my level best to resolve your problem. Okay, now we are moving towards section B. And in section B, what you have to do, you have to start reading from the requirement, not from the case, because the case relates to 5 questions, but a question would relate to only one question. So if I move on to the question directly, normally in a section B question, you are going to find 2 questions which are going to be general and would relate to the theory. You're going to find 2 general questions which would relate to theory, and 3 questions which are going to be calculation based and would relate to the scenario. So what you can do is you can simply solve the general questions first, like in this case question number 16 is general, and if I move on the next page, I would say question number 19 is general. So what you can do, solve the general questions first, because the general questions are similar to section A type questions. So let me solve question number 16 first. The question says, in accordance with IAS 36 impairment of assets, which of the following explains the impairment of assets and how to calculate its recoverable amount? So what is the asset? What is the impairment, and how do we calculate the recoverable amount? So let's see. An asset is impaired when its carrying amount exceeds its recoverable amount. This is right, because carrying amount minus recoverable amount is what is called impairment. So if the carrying amount is 100 and the recoverable amount is 80, we say that the asset has been impaired by 20. And the recoverable amount is the higher of fair value less cost to sell and the value in use. This is the right definition of the impairment and the recoverable amount. For part B, if we say an asset is impaired when the recoverable amount exceeds its carrying amount, this is right. And the recoverable amount is the lower of its fair value less cost and the disposal. This is wrong, because the lower of is not correct. And similarly in C, the asset is impaired when the recoverable amount exceeds the carrying amount. This is incorrect. And same is for the D as well, because it says the lower of its fair value. So the correct answer for 16 is A. The correct answer is A. Now let's solve question number 19 first, and then we are going to solve the remaining calculation based. The question says, which of the following are true in accordance with IAS 36 impairment of assets? So a cash generating unit is the smallest identifiable group of assets for which individual cash flows can be identified and measured. Is this statement correct or not? What do you people think? Is this correct or not? Shazeb is saying no. Why, Shazeb? This is correct. Yes, others are saying yes. So statement number 1 is correct, that the smallest identifiable group should be used to calculate the impairment loss. So if 1 is correct, this means that B and C cannot be the right answers. So I just have to see whether 3 is correct or not. If 3 is correct, the answer is C. The answer is D. And if 3 is not correct, the answer is A. So we just need to see 3 now. No, Simran, the point that we are discussing is something else. That when an individual cash flows cannot be calculated, then we move towards the CGU. And for the CGU, the cash flow should be identified. For CGU, the cash flow should be identified. Now let's read the third point. When it is not possible to calculate the recoverable amount of a single asset, then that of its cash generating unit should be measured instead. So this is also right. Both the points were already discussed when we have solved the cash generating unit in IAS 36. These two were the first 2 points in my CGU slide. So the answer is D in this case. That when individual cash flows cannot be calculated, we move towards the CGU, and CGU is the smallest possible group of assets for which the cash can be calculated, for which the cash can be identified. Thank you, Benedicta. That you have to make the question easier for you. If there are 4 options and two of the options get reduced, then the question gets more easier for you people. Harsh is saying, can you explain why point number 2 is wrong? Okay, Harsh. The question says that when considering the impairment of a cash generating unit, the calculation of the carrying amount and the recoverable amount does not need to be based on the exactly same group. Does not need to be based on the exactly same group. So if you have 2 group of assets, A and B, question is saying that you can calculate the carrying amount of A and the fair value less cost to sell of B to calculate the impairment loss. Is this possible? Of calculating carrying amount of some other group of asset and fair value less cost to sell of some other group of assets. Shouldn't the group of assets be same? Shouldn't the group of assets be same? I'm calculating carrying amount of someone else and fair value less cost to sell of someone else. No, this is not possible. So the question says that does not need to be based on exactly same group of assets. So this is wrong. Does need to be based on the exactly same group of net assets. Then when we are calculating the impairment loss, the carrying amount and the fair value should be of the exactly same group of net assets. So the not statement is actually making the statement incorrect. So if you remove the not, you would say that this is the correct statement. Okay, now let's read the question number 17 now. I'm going to read questions 17 and 18, and then I'm going to read the scenario because the scenario would follow the same sequence of the questions. You will find the answer of 17 first in the scenario, and then the answer of 18, and then the answer of 20. So you have to read two questions before reading the scenario. So the question says, prior to considering an impairment, what is the carrying amount of Telepath Company's plant and the balance on the revaluation surplus at 30th September 20x3? So we need to calculate the carrying amount and the revaluation surplus. And what is the value in use of Telepath Company's plant? So the question wants us to calculate the carrying amount and the value in use. So the difference of this is going to be the impairment and the amount of the revaluation surplus as well. So let's read the question now. The question says that Telepath Company has a year-end of 30th September and owns an item of plant which it uses to produce and package pharmaceuticals. The plant has cost $750,000 on 1st October 2010 and at that date had an estimated useful life of 5 years. A review of the plant on 1st April 20x3 concluded that the plant would last for a further 3.5 years and that its fair value was $560,000. So this part relates to the question requirement of 17. So let me solve. I'm reducing the size a bit. So we have acquired the asset on 1st October 20x0 and we are revaluing it at 1st April 2013. On this date we are actually revaluing the asset when the fair value was 560 and the remaining life on this date is actually 3.5 years, and this is exactly 6 months before the year end. And how many time from the date of purchase? How many years have passed from the date of purchase? From 20x0 to 20x1, September 20x1, September 20x2, 2 years, and then 6 months. So I would say 2.5 years up to the date of revaluation. So the cost was actually $750,000. The depreciation was 750 divided by 5. And the depreciation for 2.5 years is going to be 750 divided by 5 into 2.5 is going to be 375. So the asset has been depreciated by 375 and the net book value is now 375. When the fair value has become 560, so this means that the asset has been revalued by 560 minus 375, which is going to be 185. So 185 is the amount of the revaluation surplus. This is the first thing that the question had asked. And after this, the asset is going to be depreciated for 6 months. So the new depreciation is going to be, or I would write over here, the asset is that now 560 being revalued by 180,000 in the revaluation reserve through OCI. And now the new depreciation is going to be 560 divided by 3.5 years is going to be the annual depreciation into 6 by 12 because we have to charge for 6 months only. So this is going to be 560 divided by 3.5 into 6 divided by 12, which is going to be 80. So we are going to charge the depreciation of 80,000 and the carrying amount would be remaining as $480,000. So the question had asked you actually two values, the amount of the revaluation and the carrying amount. So these two are the right values. If there's any confusion, you can ask. Okay, Harsh is saying, why haven't we transferred the excess depreciation from revaluation to retained earning? Harsh, actually, I haven't read one of the paragraphs, which says that Telepath company adopts the policy of revaluing its non-current assets to the fair value, but does not make an annual transfer from revaluation surplus to retained earnings to represent additional depreciation charge due to the revaluation. So your answer is there in the question. Okay. Smita is saying that she haven't understood anything. That's good, Smita. And Aaron is saying, can you do that again? Okay, let me do that again. Don't worry. The question was that we have acquired the asset on 1st October 20x0 and our year end is 30th September 20x. What was the year end? 20x3. This is the year end. And we have revalued the asset on 1st April 20x3, which is 6 months before the year end and which is 2.5 years after the date of purchase. Is it clear up to now, Aaron, Duncan and Smita? Is up to here clear to you people? Okay, now I'm going to write that the cost of the asset was actually $750,000. And the depreciation is going to be $750,000 divided by 5 years, which was life of the asset, into 2.5 years would give us the accumulated depreciation of till the date of revaluation. So this is going to become 375,000. So the net book value before revaluation was 375,000. Is it clear till over here? And now the question has said that the fair value is now 560,000. So what is the amount of revaluation gain? This is actually the balancing figure. So what is the balancing figure? It is 185,000 positive. And then we are going to depreciate for the further 6 months as 560,000 divided by 3.5 years, which was the new depreciation according to the question, into 0.5 years. 0.5 years means 6 months. So this we have calculated as $80,000. So the net book value after revaluation is going to be $480,000. So this is how we have calculated, Smita and Aaron. Are you people clear now? So the question wanted us to calculate the revaluation and the net book value following the revaluation. So this is what was the requirement. So if I go back onto the answer sheet, I'm going to say that the net book value is 480 and the revaluation reserve is 185. So this is the right answer. So C is the answer. Clear to everyone? Now the question wants us to calculate the value in use. So let's move back onto the question and see what the question has to say further. The question is saying that on 30th September 20x3, Telepath company was informed by a major customer that it would no longer be placing orders with Telepath company. So a major customer is not going to place an order further. Hamzali, you have to wait. As a result, Telepath revised its estimate that net cash inflows earned from the plant for the next 3 years would be, so these are the cash flows. Telepath company's cost of capital is 10%, which resulted in the following discount factors. And this is the discount factor. So if we simply calculate the present value, we are going to get the value in use. So 220,000 into 0.91, 180,000 into 0.83, and 200,000 into 0.75, and the sum of this is going to be the answer. So 220,000 into 0.91 is going to give us 200,200. Or even what I can do is I can simply add all of them. 220,000 into 0.91 plus, you can simply use a calculator to write everything on a single line, plus 180,000 into 0.83 plus 200,000 into 0.75. So the answer is 499,600. So this is the value in use. So you can simply write everything in a single line on the calculator. So the answer is 499,600, which is actually C. So we have simply calculated the present value of the cash flows. The cash flows were there, the discount factor was there. We have simply calculated the present value. Yes, Neeraj, these are some easy marks to gain. So the examiner actually wants you people to pass. He does not want you people to fail. So always remember the passing marks are going to be there in the exam, which will be easy marks. What you have to do, you do not have to actually lose the easy marks. If you only score the easy marks and the difficult marks have been lost by you, no problem. The easy marks are sufficient enough to make a student pass in the exam. Okay, Simran is saying that hopefully these questions comes out on 5th December. Yes, Simran, hopefully. Now let's solve the 20th question. But the question is saying, what is the carrying amount of Rilda company's plant at 30th September 2023 after the impairment loss has been correctly allocated to its assets? So after the correct allocation, what is the carrying amount of the plant? So let's move back and see what the question has to say further. So this is probably the area from where we are going to get the answer. Kulia and Shazib have already calculated the answer. So the question says that Telepath company owns Rilda company, a 100% subsidiary which is treated as a cash generating unit. On 30th September 2023, there was an impairment of Rilda's assets of 3.5 million. So the impairment is of 3,500,000. The carrying amount of the asset of Rilda company immediately before the impairment were, so these are the carrying amounts before the impairment. So what we are going to do, we are going to allocate the impairment loss and then we are going to get the new carrying amount. This is what the question wants from us. So we have goodwill, we have factory building, we have plant, we have receivables and cash, which are already at their recoverable amount. So no loss is going to be allocated to them, and their value would remain at 2,500,000. Similarly, even if it's not 100% owned subsidiary, the answer would remain the same. Now, first the loss will be allocated to goodwill, which is 2 million. So the goodwill is now 0. So the remaining loss will be allocated to between these two of them, which is 1,500,000 is the remaining loss to be allocated. So I'm calculating on the plant. So this is going to be, the plant is actually 3,500,000 out of 7,500,000, the sum of both. The plant is 3,500,000 out of 7,500,000. So which is going to be 3,500,000 divided by 7,500,000, which is actually 46.67%. So I'm going to multiply 3,500,000 by this. Okay, sorry. 3,500,000 divided by 7,500,000 into 1,500,000, which is the amount to be allocated. So the loss to be allocated is 700,000 to the plant. So the new value is going to be 2,800,000 after the allocation. Ahmed Junaid is saying, please repeat the sequence. Ahmed, first the impairment is recorded in goodwill, and then obviously impaired asset, and then prorate. Goodwill, obviously impaired asset, and then prorate. This is the sequence that you have to follow. Yes, Neeraj is right. So the answer is going to be 800,000, which is B in this case. So the right answer is B for question number 20. Any questions so far? Okay, that's good. Now we have done 1/3 of section B. Now we have 21 to 25 and then 26 to 30 and only 20 minutes left for today's session. So let's move to 21 to 25. This time again, you will find two general questions, which is question number 21 and question number 22. These two are general, and the remaining you would find which are actually the question based. So let's solve these two first. Question 21 says that which of the following must exist for an operation to be classified as discontinued operation in accordance with IFRS 5, non-current assets and the discontinued operation. Okay, people want to take a snapshot of the CGU working. Okay, so this is the CGU working. And the allocation is 1500 into 3500 divided by 7500, which has given us 700. Have you people taken the snapshot? Okay, so now we are discussing question number 21, where the question says that which of the following must exist for an operation to be classified as discontinued operations in accordance with IFRS 5. So we are actually going to discuss the rules of classification of IFRS 5. So the first point is that the operation represents a separate major line of the business or the geographical area. So it should be a separate line of the business to be treated as discontinued operation. So this is right, because the operation should be a separate business and a major line of business. If it is minor, it is irrelevant, it is not material, then we are not going to apply IFRS 5. And second, the operation is a subsidiary. So is it a must that the discontinued operation should be a subsidiary? The answer is no. So we know that one is correct. So A and B is not the right answers. So we do not need to study adjustment number 4. We just need to see out of 2 and 3 which is right and which is wrong. And the 3 said that the operation has been sold or is held for sale. Yes, this is right. So the answer is C, 1 and 3. So again, these are some easy marks. Simran, if the business has been sold, it is a discontinued operations because it has been sold. That's why it is discontinued. So either it should be sold or it should be held for sale. In adjustment number 4, the question says that the operation is considered not to be capable of making a future profit following a period of losses. So the question is saying that a loss-making business should be classified as operations held for sale. So the answer is no, that is not the case. Adjustment 4 says that a loss-making business should be classified as held for sale. So it is not necessary. We can even sell a profit-making business. We can even sell a profit-making business. So the losses are not a requirement of held for sale. So let's try question 22, where the question says that IFRS 5, non-current assets held for sale and discontinued operations, prescribes the recognition criteria for non-current assets held for sale. For an asset or a disposal group to be classified as held for sale, the sale must be highly probable. Which of the following must apply for the sale to be considered highly probable? Yes, Simran, you are right. So a buyer must have been located. Is this the criteria? The answer is no. The buyer must be, we should be trying to locate a buyer, but it is not a must that the buyer has been located. So one is incorrect. So option C and D are wrong, which means that 3 is always going to be right. So either 2 is right or 4 is right. So we can even decide if 2 and 4 is the right, we are going to get the answer. So the asset must be marketed at a reasonable price. Yes, this is right. The price should be reasonable. The management must be committed to a plan to sell the asset. This is also right. The management should be committed to sell the asset. And the sale must be expected to be taken place within the next 6 months. No, it should be taken within the next 12 months. So the answer is 2 and 3, which is going to be A. So in every section B question, you are going to find 2 general questions and 3 specific to the scenario, or I would say 2 theory questions and 3 calculation based questions. So 60% of section B is going to be calculation based and 40% is going to be theory based. So let's read question 23 and then we are going to solve the and then we are going to read the scenario. Nazia, actually I've discussed this in detail in IFRS 5. So if you people want or if you want to recheck this, you can see in the presentation of IFRS 5. So question number 23 says that what is the employee cost associated with the closure and the sale of Newton Company's factory, which should be charged to profit or loss for the year ended 30th September 2023. So which value should be recorded as an expense in P&L in the current year? So let's see the scenario. The question says that at a board meeting in June 2023, Newton Company's directors made the decision to close down one of its factories by 30th September 2023. So we have decided to close down a factory by 2023 and market both the building and the plant for sale. The decision has been made public and was communicated to all affected parties and was fully implemented by 30th September 2023. So this is actually something relating to IS 37, which relates to the accounting of restructuring. So this is something which relates to restructuring. So let's see, the question says that the directors of Newton Company have provided the following information relating to the closure. Okay. Of the factory's 250 employees, 50 will be retained and deployed to other subsidiaries. Retrained, the word is retrained, not retained. So 50 are going to be retrained and deployed to other subsidiaries within the Newton Group during the year ended 30th September 2024. So we are going to retrain them in 20x4 at a cost of $125,000. So the cost of retraining, should it be capitalized or be expensed, and in which year? The retraining cost is normally an expense, but in which year? Should it be expensed in 20x3 or 20x4? The retraining cost, should it be expensed in 20x3 or 20x4? Okay, a lot of right answers. Yes, the retraining cost is expensed when incurred. The retraining cost is expensed when incurred. So as this is going to be incurred in 20x4, so this expense relates to 20x4 and not 20x3. And the question had asked the expense of 20x3, so this is not going to be included in the expense. The remainder accepted redundancy at an average cost of 5,000 each. So the remaining are 200 employees who have accepted a 5,000 amount per employee. So 200 employees into 5,000 per employee is going to be $1 million is the amount that should be expensed out to P&L. Yes, Simran, this would become current liability. Now, if I move towards the question requirement, which was beneath, so the answer for 23 is actually D. D is the right answer, 1 million. Okay, now let's read the next question. Question number 24. The question says that what is the profit or loss on the discontinued operations relating to property, plant, equipment for the year ended 30th September 2023? So we have to calculate the gain or loss on the property, plant, equipment. And further, the question says that in respect of operating losses and penalty payments, what provision is required in the statement of financial position of Newton Company? So we have to calculate the provision in question 25 for the operating leases and the penalty payments. Okay, let's move towards the question and see further. The question further says that the factory's plant had a carrying amount of 2.2 million, but it is only expected to sell for $500,000, incurring $50,000 of the selling cost. So the plant has a carrying amount of 2.2 million, which is 2,200,000, and the fair value of 500,000 and the cost to sell of 50,000. So which means the fair value less cost to sell is 450 and the carrying amount is 2,200. So what is the amount of loss? The differential, 2,200 minus 450, which is going to be 1,750 is the amount of the loss to be recorded in P&L. Smita is saying, sir, how is redundancy an expense? Smita, this is something related to IAS 37 where we record a provision of redundancy when we decide to make the employees redundant and we announce it publicly. So as the criteria were met, that's why we are recording the expense beforehand. Okay, so the questions further say that factory itself is expected to sell at a profit of 1.2. So under IFRS 5, do we record the property? No. Do we record the profit? The answer is no. We only record a loss. So the loss is of 1,750. So the answer to the question is going to be a loss of 1,750. So the right answer is A in this case. So we only record the loss and not the profit. According to IFRS 5, we do record the loss, but we do not record the profit. We do record the loss, but we do not record the profit. So we are going to record a loss of $1.75 million. Shazib is saying for redundancy, why we not record provision? Shazib, we do record a provision. The entry is expense debit, provision credit. For redundancy, the entry is expense debit, provision credit. So both are there. Yes, Simran, under IFRS 5, being prudent, we immediately record the loss that will be there when we sell the asset. So this is according to the prudence concept that even if the loss has not incurred, record it beforehand when you know that the loss would be incurred. Okay, now let's see part C. No, Emma Junaid, the redundancy cost is going to be expensed in 20X3 because the criteria has been met. Simran, recording the profit is against prudence. Profit is recorded when it has been incurred, and the loss is recorded beforehand, before being incurred, before when it is expected. So according to prudence, if you want me to write it over here, according to prudence concept, the future expected losses are recognized when they are expected, but future, or I would say beforehand, but future expected gains are only recorded when incurred. So you cannot record the gain beforehand, you can record the loss beforehand only. So let's get back to the question. This is the working. Syed Maz, you can take the snapshot. Okay, now let's discuss the last part of this question, and then we will be having 4 minutes in total from now. So we'll be extending the session for 15 minutes so that we can at least be able to complete section B. Now the question says that the company also rented a number of machines in the factory under operating leases, which have an average of 3 years to run after 30th September 2023. The present value of these future lease payments, or I would say that the operating lease is something that has been outdated now. So I'm removing this. The company has also rented a number of machines in the factory under leases, which have an average of 3 years to run after 30th September 2023. The present value of these future payments at 30th September 2023 was $1 million. So the liability, the lease liability is of $1 million. Yes, Harsh, I will show the rules later so that you can take the snapshot. So now the lease liabilities of $1 million. However, the lessor has stated that they will accept $850,000 if paid on 30th October 2023 as a full settlement. So as we are discontinuing the business, we will also discontinue the lease. As we are discontinuing the business, we will also discontinue the lease. So what is the amount of loss that we will incur? 1 million or 850? If we are discontinuing the business, we have to cancel the lease. And what amount will we be required to pay? 1 million or 850? 850, yes, because this is the lower amount. So we will be paying 850,000. Then the question further says that the penalty payment due to the non-completion of supply contracts, because we are canceling the contracts, are estimated to be $200,000. So this is the penalty that is going to apply on us. 50% of which is expected to be recovered from the Newton insurers. So should we consider the insurance? The answer is no. Okay, so should we consider the insurance? The answer is no. So the provision recorded should be of 1050000. This is the amount of the provision that should be recorded. Yes, this would have been considered if it would have been virtually certain to receive the insurance. So if the question says that it is expected to be recovered, the expected is not enough for the asset to be recognized. So the answer to 25 is going to be C, that the provision should be recorded at 1050 and 000. Simran is saying reimbursement is considered when it is virtually certain, right? Yes, Simran, we would have considered this if it would have been virtually certain. Now let's move on to the last question, question number 26 to 30. Elvis is saying, what is the makeup of the final figure? Elvis, the makeup of the final figure is 850,000 and 200,000, which is 1050 000. So you can take the snapshot of this. 850 relating to the lease, cancellation of the lease, and 200 relating to the penalty. Yes, Simran, if it would have been virtually certain, we would have netted it off. Yes, Smita, we would have considered it if it would have been virtually certain. So the reimbursement would have been considered if it would have been virtually certain. So let's move on to question 26 and see some of the general questions. So question number 26 is general. And if I see the remaining questions, I would say question number 30 is general. So in every section B question, you are going to find two general questions relating to theory and the remaining relating to scenario. And if I move back onto the question, let's solve question 26, which is general first. The question says that which of the following meets the definition of a financial asset in accordance with IFRS 9? So what is the definition of a financial asset? An equity instrument of another entity. Yes, this is a financial asset. So D is not right. Any contract which evidences a residential interest in the assets of an entity after deducting all of its liabilities. Is this a financial asset? The answer is no. This is actually the definition of an equity. This is actually the definition of an equity, the residual interest in the assets after deducting all of the liabilities. So this is not the right answer. So A is not going to be the answer. So I'm going to say that 4 is always going to be the right, which is cash. Yes, cash is a financial asset. So now we have to decide whether point number 3 is a financial asset or not. So point number 3 says that a contract to exchange financial instruments with another entity under conditions which are potentially unfavorable. Unfavorable means a loss, and a loss means a liability, not an asset. So this means that 3 is also not right. So the answer is actually B. The answer is actually B, that 1 and 4 are the financial assets, and 2 is the equity, and 3 is the liability. So 1 is asset, 2 is equity, 3 is liability, and 4 is the asset. So answer is 1 and 4, which is B. Simran is saying, what is the difference between 1 and 2? Simran, in 1, this is an equity instrument of another entity. And in 2, this is our own equity. In 1, the equity instrument is of another entity. The equity instrument is of another entity. And in 2, the equity instrument is of our own entity. So equity of our own entity is equity for us, but equity of another entity is an asset for us. Getting the point, Simran? Okay, now there's a question from someone else as well, that Cooley is saying it should be 1, 3 and 4. Cooley, why not 3? Because 3 is an unfavorable transaction for us, and an unfavorable transaction means a loss, which is a liability, not an asset. If it would have been a favorable transaction, then we would have treated it as an asset. Yes, Nazia, you are right. Harsh is asking why cash is a financial asset. Harsh, I cannot answer you why right now, but only learn that cash is a financial asset. Okay, now let's read question number 27, and then we will be reading the scenario. In respect of financial assets of speculate company, what amount will be included in other comprehensive income for the year ended 30th September 2023? So what amount is to be included in the other comprehensive income for the financial asset, which means the question is talking about fair value through OCI, where we initially record this at the cost. And the word cost means the fair value plus the transaction cost. So the question is talking about fair financial assets with the movement taken to OCI. So this is the rule for the financial assets with the movement taken to OCI. So let's see, the first point relates to financial assets, where the question is saying shareholding A is a long-term investment. Long-term investment means fair value through OCI in 10,000 of the equity shares of another company. So we have 10,000 shares. These shares were acquired on 1st October 20x2 at a cost of 3.5 each. So we have paid 3.5 each, which would become 3,500 or 35,000. Yes, 35,000. Transaction cost of 1% on the purchase price were incurred. So the transaction cost is 1%, which will become 350, which is going to be capitalized. So the cost is 35350. I'm also checking with the calculator. 10,000 into 3.5 multiplied by 1.01 will include the transaction cost, which is 35350. So yes. On 30th September 20x3, the fair value of these shares was $4.5 each. So the fair value is 10,000 into 4.5, which would become $45,000. So the increase is actually 9650, which should be taken to the OCI. So 9650 is the right answer. You can take the snapshot so that I can move towards the question. So the answer in this case is going to be A, 9650. So initially we have recorded at the cost, which is the fair value plus the transaction cost. Okay, thank you, Kuli. No, Ahmed Junaid, transaction cost will be expensed out if it would have been a fair value through P&L. In fair value through P&L, we expense out the transaction cost. But in fair value through OCI, we capitalize the transaction cost. Yes, yeah, now you're right. So let's move on to the next question, question number 28. The question says that what is the total amount which will be charged to the statement of profit or loss for the year ended 30th September 20x3 in respect of the taxation. So now the question is talking about taxation. So if I move back, now the question is talking about this taxation. So the question says that the existing debit balance on the current account tax is 2.4 million, which represents the under-over provision of the tax liability. So the entry is going to be tax expense debit and the current tax credit by 2400. This is an entry similar to final accounts. That this was a debit balance by the current in the current tax account of 2.5 million, representing the under-over provision of the previous year. So we are going to credit this to calculate the tax expense. Okay, Simran, you have to wait for a while. And then a provision of 28 million is required for the income tax for the year ended 30th September 20x3. So we are going to write provision for tax of 28 million. And then the existing credit balance on the deferred tax account is 2.5 million. So DTL brought down is 2.5 million. And the provision required at the year end is 4.4 million. So DTL carried down is 4,400. So we are going to credit the deferred tax liability by the difference. So 4,400 minus 2,500 is going to be 1,900. So the liability should be increased by 1,900. Yes, Simran, provisions means an estimate. So 1,900 plus 28,000 plus 2,400 is going to give us the total, which is 32,300. So this is the amount that was asked by the question. So you can take a snapshot of the calculation, then I will mark the answer. You people can take a snapshot, then I will mark the answer. Simran, if you want to prepare a T account, you can say that this is the deferred tax liability account, the brought down of 2,500 and the carried down of 4,400. The balancing figure is P&L. Yes, Junaid, it is current tax prior year. By under over provision, the question means prior year. Okay, so the answer is going to be 32300, which is C in this case. So C is the right answer. It is the same, Shazib. Current tax, current year, and provision for tax is the same. Current tax, current year, and provision for tax is the same. Okay, so now we are moving towards the second last question, question number 29, with the question says, what is the amount of deferred income in which Speculate company should recognize in the statement of financial position as at 30th September 20x3 relating to the contract for the supply and servicing of the goods. So the question wants us to calculate the amount of the deferred income. So let's see the question. Simran wants to see the P&L expense. Simran, this question 27 is the P&L expense. So you can take the snapshot now. The double entry P&L expense. Now let's read the last part of the question, which is revenue. The question says that on 1st October 20x2, which is at the start of the year, Speculate company sold one of its products for $10 million. As a part of the sale agreement, Speculate company is committed to the ongoing servicing of the product until 30th September 20x5, that is 3 years after the sale. The sale value of this service has been included in the selling price of $10 million. So actually the $10 million relates to both the goods and the services. And the services of 1 year has actually passed. So I can record the revenue of the goods and the 1 year service. But I cannot record the revenue of the last 2 years. This is something that we have already discussed in final accounts as well. The estimated cost to Speculate company of the servicing is $600,000 per annum. In Speculate company's gross profit margin on this type of servicing is 25%. So can you calculate the selling price of servicing? Can you calculate the selling price of servicing? It's going to be 800. Yes, 0.8 million or 800,000 is the answer. So we can record the revenue of 800 for the first year, but remaining 2 years, 1600 cannot be recorded as a revenue. And out of this 1600, 800 is the non-current liability and the remaining 800 is the current liability. So the question has asked us the total deferred income, which is going to be 1600. You can take the snapshot so that I can move on to the question sheet. Okay, now the question was asking what is the amount of deferred income? So the amount of deferred income is going to be $1.6 million. So your answer is actually B. So your answer in this case is actually B. This is the right answer. Yes, Simran, you can call it accrued income or deferred income, but it's better to call it deferred income or the unearned income. Okay, now in question number 30, the question says that which of the following are true in respect of the income which Speculate company has deferred at 30th September 20x3. So now we have to identify the correct statements. Which statement is correct? For this, the question says that the deferred income will be split evenly between current and non-current liabilities in Speculate company's statement of financial position. So is this right or wrong? Is this right or wrong? This is right. We have to split it equally, 800 in current and 800 in non-current. So option B and C are not going to be correct. So either 2 is correct or 4 is correct. So I know 3 is incorrect. So let's study 2. The cost associated with the deferred income of Speculate, the cost relating to the servicing, should be recognized in the statement of profit or loss at the time the revenue is recognized. So the cost will be recorded at the same time as the revenue is being recognized. Is this right or wrong? Is this right or wrong? Yes, this is right. Matching concept. This is the matching concept, that the revenue is recognized when the cost has been recognized. So statement number 2 is correct. This is the matching concept. Recognize the revenue when the cost has been incurred. And in 4, the question says that when recognizing the revenue associated with the service contract or speculate, the stage of its completion is irrelevant. The stage of its completion is irrelevant. This is wrong. The stage of completion is always relevant, that you have to recognize the revenue according to the stage of completion. So this is relevant, this is not irrelevant. So the answer to this is going to be A. So the answer is going to be A. So now we have completed the section number A and we have completed the section number B. So we have approximately solved a lot of questions. So total 30 questions of this, and we have approximately solved 10 questions in the normal 5-day session. So approximately we have solved 40 to 50 questions of section A. And for section C, we have solved in total 7 questions relating to 3 relating to final accounts, 2 relating to consolidation, and then 2 relating to ratios. So Alhamdulillah, we have solved a lot of questions, 40 to 50 section A and B questions and 7 section C questions. I hope the session was overall useful for all of you people. Simran wants me to explain adjustment point number 3. Point 3 says that the deferred income can only be recognized as revenue by speculate when there is a signed and written contract of the service with its customers. So this is not a rule that you are not required to sign a separate contract for the servicing. It is included within the same contract. It is enough. Oral is also allowed, yes. So the written agreement is not necessary. So that is all for today, everyone. I will be sharing the answer of section C on the WhatsApp group. So stay tuned over there for the answers. And if any one of you is not there on the WhatsApp group, you can contact me personally on my contact number, but try not to call, only drop an SMS on WhatsApp group or WhatsApp me personally. I want you people to submit the feedback after the session ends, because that form is more relevant as compared to the feedback over here. I hope it was a useful session for all of you people and the time invested was worthwhile. Thank you everyone. Best of luck for the exam. Take care and Allah Hafiz.